Hello, this is Gary Aldridge with LeveragingYOU.com. And the purpose of the podcast is to bring subject matter experts to the table so you can hear from other people besides just listening to me all the time, and then expand the body of knowledge and give some helpful tips that help you maximize the value of your business and make it more sellable. Okay, so today we're fortunate to have Jeffery Oboy from New York. And Jeffrey's with Paratus Capital. And Jeffrey and I work together. We were kind of on two different sides of a potential opportunity, and we'll get into that in a minute. But I just want to welcome Jeffrey and thank you for taking the time to join us today.
Well, thank you, Gary. A pleasure to be here and join you.
Jeffrey, tell us a little bit about yourself first, and just and I know you've told me, but tell us for our listeners just who you are and how you migrated to New York and what you're doing with Paratus.
Well, happy to do so. I think, first and foremost, I'm originally from the Midwest. I grew up in Indiana, born and raised, went to Purdue University. And yeah, in short, to your question, kind of how I came to about New York, often that's a primary destination right out of school for many, if not, West Coast, Silicon Valley. My journey kind of took a little bit of an alternative route. In fact, there were a couple of spots abroad before I actually came to New York. So your question, kind of what brought me to New York? Opportunity for sure. I think that's the story for most folks. And that was no different here. I came to New York actually in 2016. Actually having spent about 10 years between Europe and the Middle East. At the
Wow.
time, yeah, at the time, I was based in Dubai, running and growing the firm I was a partner with, part owner, for several years. The practice there, not only concentrating on our clients in Dubai as well down the road in Abu Dhabi, but as well the overall region across the Middle East. And so that was where I was at the time. But ultimately, opportunity knocked. There were some great growth opportunities for the firm for us to go after back in the U.S. And I got the nod to do just that. The firm's roots were, as I mentioned, European, German, and so I guess it was sensible to send the American back home to give it a whack.
Awesome. I didn't know that you spent time in Europe and the Middle East. We'll have to have a sidebar conversation about that. I always love to hear about things international and people working over there. I had a couple of opportunities, didn't pan out for me, but decided it's a lot more comfortable and convenient here. But I've not been to Dubai and Abu Dhabi, so I'd love to hear more about that in a separate conversation. So I know that you're with Paratus Capital. So just give us a little insight as to who Paratus is and what they do and your role with them.
Yeah, definitely. So Paratus Capital is a search fund. It's a search fund that I founded just over 2 years ago. Ultimately, as I mentioned before, I was part owner in a business, helping to grow it, and eventually arrived to a moment where it was time for a change. And when I reflected on what that could look like, without question, I wanted to run another business. It was something that I never necessarily set off to do in my career. I studied mathematics, so I thought I'd be sitting behind a desk crunching numbers my life. Something I was good at, but things played out in my career that I learned that I had a passion for growing, leading organizations, and at the same time, all things marketing and sales. And so, coming to Paratus, I decided to launch this search fund with a quest to find an interesting business where I felt not only would I be happy and fulfilled, but that I could deliver value to that organization and where it could go next, assuming the owner of the business, was at that moment to pass the baton. So Paratus is exactly that.
So do you have some other folks working alongside you with Paratus in any kind of capacity, or what's the company structure look like today?
Sure. So yes, in a few different capacities. We don't have any full-time employees. Ultimately, Paratus is a means to an end. Once we find our acquisition, which I think we'll get to momentarily, what we're looking for, Paratus, from a search and acquisition standpoint, will pause, and all focus for myself and relatedly our LPs will shift to the business that we've acquired. But in terms of who helps me, I do have a select group of investors that are very active in helping me to evaluate deals, certainly value them as well. and try to push that deal across the finish line. Furthermore, as we'll get into just kind of the grind that is, I do have a few students that are really
Okay.
keen to go into careers in finance that are accompanying me, we'll say, in this quest to find the right acquisition. So they're extremely helpful to that end, and just prospecting and finding what's right, and then certainly learning along the way how we, in fact, think about deals, analyze them, evaluate them, and so forth.
Well, you told me that that this is a search fund and you're looking for a specific opportunity. So, exactly are you looking for? What type of opportunity are you looking for that you say, "Hey, that's it. That's the one. I'm going to jump."
Truth be told, it's a bit of a needle in a haystack. I think to summarize it plainly, but maybe to provide a little specificness to this. So we are, for the most part, U.S. focused in terms of where this business not only should be headquartered but operate for all intents and purposes. There have been a few circumstances where we've seen some interesting businesses north of the border in Canada, but generally speaking, our mandate, our focus is the U.S. What we're looking for, and I think to just distinguish compared to other investors, we are looking for businesses that have proven themselves and their ability to not only generate revenue but as well profits, bottom line profits. So we are not venture capitalists, waiting for another day for profits to be turned and following that thesis. We are looking for business that oftentimes a private equity firm also
Hmm.
might consider, but with some notable differences around our investment criteria compared to theirs.
Is there any specific industry that you're looking at, or just a profitable business in any industry?
So profits are important. In terms of industry, we've covered many different industries, I would say, up until now, with a variety of different themes related to them. Happy to go into some of those maybe as we go. I think what I'll say to this, where search funds have found most traction and impact in my research has been where there's no actual real industry that defines that company today,
Hmm.
given the nicheness of what they offer. I mentioned a moment ago, private equity, at least in my research here, generally have a thesis that they pursue, notably around consolidation. I'd like to buy 10 companies doing the same in terms
Mhm.
of product or service offering, merge those together so that I can generate value that way. In short, we have looked into some of those industries, but we've concluded we are just not the right fit there in order to match ultimately the investment thesis that those groups have. We're really focused on special, more or less common business that has good organic growth potential, and relatedly is in an industry that, or what's for that matter, has a path of growth ahead of it.
Scalability.
Scalability and just room to grow.
Right.
Certainly, it's great if the business can increase its profit margins as it grows, but that's not a prerequisite. We have looked and found some really interesting businesses that will continue to grow their cost base as the revenues do as well, but more importantly, have the ability to just grow and expand their impact.
Now, correct me if I'm wrong, but I think you told me once upon a time that you were focused more on a technology related industry. Is that correct?
Yes, broadly speaking, software has been a thesis, notably actually this past summer. I decided to kind of hold back on this industry thesis early on in my search. Back to Paratus, I founded this again, just over 2 years ago, and early on, it was my belief that the market was a little bubbly, if you will, in all things software, and so I elected to hold back until, well, essentially the back end of my search, and that was this summer. Um, Software, generally speaking, you can find a lot of less common nichier businesses catering to some business problem, helping things be more streamlined, optimized, etc. And so it's generally speaking a good spot to find your more nichier businesses, less roll up plays, if you will.
What are the types of things like the green flags, the good things that you see in a business or that you want to find in a business that would lead you to want to acquire that business? What are the pros, and we'll get to the cons in a minute, but what's the good side of that ledger look like? If it's got this, and this, that's the kind of thing that I want. What does that look like?
I think a criteria that would be shared amongst any investor type, regardless if they're looking into the niche or industry or large fragment, is a diversified customer base. For me, this is a green flag that this business is bigger than one individual or two or three if there are multiple founders. Oftentimes, given the size of business we target, which is in the lower middle market, it's hard to know for certain, is the business something that will continue to operate post exit, or will it collapse the moment the owner walks away with perhaps all their relationships, or for that matter, know-how on how to actually deliver on the revenue that's been sold. So, diversified customer base.
I've worked with a number of different businesses in different capacities, especially doing some business valuation work. There were three specifically that had a lot of revenue tied up in one customer. One of them, 2 weeks after we signed the engagement, he calls me and says, "I just lost customer A. That's 60% of my revenue." Another guy that I worked with for some years, same thing happened, lost a customer, 60% of his revenue. Another was about 35%. So those are hard hits. Two of those guys were able to survive and until they could, build their revenue base back up and, thrive again. The third did not survive. But I understand the, and I wouldn't think that people would be lettered up on one customer, but in reality, sometimes they are. So I understand that. What are some other green flags you would look for in addition to diversified customer base?
Sure. Other things. I mean, here we kind of now gravitate more into our own investment criteria, which are certainly not going to be, every investor's and relevant to every company. But I think maybe looking to the current market climate, what's maybe very important for business owners right now is a demonstration of profit. In the end, when you open the kimono and start going through the exploration, who knows how your accounting has been done and what costs relate to what. In the end, profit is a profit.
Mm-hmm.
And so profit has not only been a prerequisite for us and our investment thesis pre the current market environment, but with more skepticism, more scrutiny being placed by investors on what actually is the path to profit, because why else would anyone invest if they don't have a path to dividends?
Right.
That's really important, broadly speaking.
What about, could you speak to the leadership of the company? What would you look for? How does that play into something that you would want to acquire?
Sure. I think this, partly segues back into that first criteria in terms of just the customer diversification. Like what actually has been built here? A business is built to create value for customers, and that's eventually reflected in revenue and ultimately, hopefully, profits. The business, we don't have to go through the definition of what a business is, but in the end, it is highly dependent and focused on its people. Not only the people at the top, but obviously the people that actually deliver the work. And so back to when we evaluate businesses, we want certainty that there is something there beyond just one individual that will maintain continuity at the very least during transition, but also in terms of their own growth and where they're going in their own careers. Again, the employees of the firm. So we absolutely look to it. Without question, there are always areas in every organization where they could be stronger. Perhaps they're lacking some skill set or expertise on the finance side, or R&D, marketing, sales. Just spoke with an owner today in that specific regard. There are always things that can be improved, but something that will offer some continuity, know where the light switch is per se, is really, really important.
What about we talked about some green flags. What are some red flags that if you found in a business would make you want to decline that opportunity? What are some red flags, some cons?
I mean, the inverse, if you will, of a diversified customer base is the opposite, right? That's the easiest place to start. And relatedly, companies that are just extremely owner dependent. They are the business. You pull them out of the business, there's no business, at least in terms of revenue generation, profits. I think this is, often a hard thing to grasp when you are the one owning, that is, running the
Mhm.
business. But the moment you put yourself in the other seat, that is being an investor, the question in the end is, what are you buying? And or for that matter, who are you buying?
Exactly. Worked for a gentleman some time ago and small business. He was more of a sales oriented type of CEO, had been successful. And we're talking about valuing the business. And he said, well, I wouldn't sell my business for less than $5 million. And I said, that's great. What does the buyer get? Okay. If I stroke you a check for $5 million, what do I get? There's no land, building, or equipment. You got a couple of computers, you got 4 or 5 people. Basically, you are the business. And without you there, there's no value, because I don't get anything. I'd have to go out and get my own customer base and get my own suppliers and that kind of thing. And it really didn't listen to him. He said, well, I still wouldn't sell it for less than 5 million. I said, well, I get that. But I mean, reality is no one's in the right mind going to write you a check for that. But I mean, you can value it however you want, right? You could ask $10 million for your house, but if it's only worth 500,000, then that's what it's worth, right? The buyer, at the end of the day, the buyers, this is a hard point for some business owners to get. The buyers are the ones that tell you how much your business is worth because they're the ones that are stroking the check. So they're the ones that get to decide that. And that's why 70% of businesses don't ever sell. They just close the door because of the value gap, the difference between what the seller thinks it's worth and what the buyer's willing to pay. I'm going to bring this up because Jeffrey and I, we connected on LinkedIn and then got a little idea about what he was looking for. Then I had a client that I thought might be an opportunity for him. So we worked on opposite sides of the fence for an opportunity, which at the end of the day ended up declining on. So, and I'm bringing that up to say you were just talking about the owners being the business and being heavily involved in the business. So, we'll leave things, we'll protect the privacy of the customer. We won't mention their name, but you can speak directly about the red flags that you saw. I mean, it's great people, great company. It was making money and all that. But what were the red flags that you saw that had you walk away from that opportunity?
In short, the owners were the business
They were.
and nothing more. At least, what was uncovered, in the preliminary diligence. I think, just, again, respecting the privacy, there were some, really exciting boxes ticked, which we don't come across every hour, or for that matter, day. It was a niche focused software business focused on a particular vertical, an extremely large vertical in terms of just the number of potential customers out there. And what they were doing for their select customers had applications to the rest of the market. So there was really good growth opportunity as well. But coming to at least how our group was able to value this business, and then we are looking to the profits and understanding, okay, and the revenues that come in every day, every week, every month, every year, what's finally left over for the so-called shareholders of the business. In this particular case, the 3 owners delivered the work. They were the IT, they were the help desk, things of that nature. And after you had accounted for their salaries and their benefits, which they had viewed as quote unquote add backs, we'll talk about that later. The reality was that there was substantially less bottom line profits left over for ultimately what an investor could rely on as a forward-looking dividend.
Right.
And it was substantial. I don't remember the exact numbers, but it was maybe 70 or 80% less profit than at least they thought from the add back discussion. So this is important, and I think add backs were a new thing for me. When I embarked on this, I don't come from the M&A world. In my former world, I was an owner myself, and understanding what this is, and back to your point, what am I buying? It's a bit of a obtuse consideration here, but the key here is if you are the investor and you're paying X amount for this business, what type of return will that generate next year? But very important, if those owners are stepping out, revenues flatten, you could very well be not getting any dividend. So then why would you do it?
Right. Right. You could be upside down pretty quickly. Yeah. Separate from that opportunity, I'm working with a different client now to literally scale his business so that, because he started it 10 or 15 years ago, he's built it, and we're talking about his exit and how much he wanted and when he wanted, that kind of thing. That in order to do that, we've got to work your way out of a job. We have to get the business running so well so that it can keep running after a buyer buys it and you're gone, and it keeps going. The wheels keep going. They don't fall off. So we're taking some steps to do just that. We quite literally put him on a 90-day plan that said, okay, I'm a part of your weekly staff meeting, which he runs. And so we're going to do that for a while. And when we get some stability there, then you're going to hand that off, and Billy's going to run it or Sally's going to run it. You can still be there, but they're going to be doing, like right now, you're doing 90% of the talking. So we got to, it's hard to get owners because, when they started, they were doing everything, right? So it's really hard for them to let go and let other people get in there to give them not only responsibility, but authority to run the business and make decisions. And sometimes they make mistakes or they do something in a way that's different than how you would have done it. But those are all learning opportunities, right? But at the end of the day, you got to figure, do you want to control the business and remain small, or do you want to get bigger, and work your way out of a job? And to do that, so we're on a kind of a plan to kind of segue him out of there over kind of a 90-day, maybe 3-month, maybe 6-month window to where he's eventually not even in the meeting. That's the ideal, and then he's got somebody else that's driving sales and someone else is driving operations, someone else is driving accounting and finance, where he's not, because he knows his business cold. He knows it like the back of his hand. That's great. Now we got to get other people to know it like the back of their hand so they can do the same thing without you in the room. So that's scalability. That's working your way out of a job. Talking to the business owner here. If you want to get maximum value for your business, that's what you got to do. It's hard to do. I get it, but that's what you got to do over time. And for the buyer, okay, Jeffrey's the buyer here. He's looking for a business where he can take them and fold it right into his portfolio, and then he's not losing everything because the owner's not there, right? So he's not looking to buy the owner; he's looking to buy the business. So we got to get business owners working themselves out of a job.
Absolutely. If I maybe kind of throw a few just additional perspectives on that, Gary, if possible.
Please.
I think, to be sure, every company needs someone to unite a direction. Generally, they go by the name of a CEO or president, less commonly used in a sole proprietorship. But nevertheless, that's what we're talking about here. So unless the business is being acquired and, engulfed, consumed by a bigger mothership, back to what we were speaking before about PEs with their maybe consolidation theses, that's needed. The PE group, they can take the assets per se. They can say, thank you for all the customers. Thank you for the employees. And we're also going to just transition into our noble, modus operandi in terms of processes, tech. But, assuming that this business doesn't have that option, there needs still to be a CEO. But the other thing, what I've come to recognize, and just speaking to owners myself, it's far from easy to go to that next level of revenue and profits that's required to justify making those investments and those qualified second level of management. And those investments come with a risk. And depending on the conviction, the financial situation of the owner, that may or may not be the right option and choice for them. So it always depends, is what I've found, depending on just the industry you're in, what is that M&A activity look like around it. And, what I've also, though, concluded, there is an option for everyone. When I started this, I thought there was just private equity in the world, aside from publicly traded companies. I obviously learned of search funds and their value proposition. There are independent sponsors, and there are a variety of others that have other theses. So it's understanding, what it is you're looking to achieve, what you're willing to risk, and finally finding the right partner for you, because not all investors are the same.
That's absolutely true. Yeah. Um, that's a whole other conversation, and a good conversation to have, because people talk about finding equity. Well, it depends, because when you take somebody else's money, then some hooks come with that money, and different people. Some want to be a passive investor, some want to control, and everything in between. So they're all over the board. Um, so, what are some actionable items that a business owner could take to help maximize their business value and or help make it more sellable?
Woof. Big question. Hey, thank you.
You told me to ask that, so that's why I'm asking.
Yeah, right. Oh, yeah, right. It was a few weeks back we had this conversation. It's a late Monday afternoon. It's already a busy week. No, I think, as any, good advisor consultant says, it depends, right? But I think what I would, frame this around are three things, and that is the ultimate drivers of this valuation in absolute terms: the profits the business is generating, the growth path it's on, and finally, just the risk.
Right.
How likely is it that this growth plan materializes? How likely is it that you get hit by a huge competitor and tomorrow you're actually worth nothing as a business, regretfully? These are the three, drivers of the ultimate valuation calculation, so-called total terminal enterprise value, and I think that's where we
Right.
can focus the conversation, right?
Right. I think too many times we don't talk about risk enough. One of my videos actually is all about risk, because the buyer, what I'll tell and teach business owners is, the more time and money and people that the buyer has to put into your business to get it where he wants it, that's the less value he's going to pay you. So the less time and money and people that he's got to put into your business, that means more value to you. And the way that happens is, and I've got a checklist. There's about a dozen different risk factors. One of them you mentioned, customer concentration is one. Supplier concentration is another one. Your talent pool, your executive pool, your competition, pricing, location, geography, industry. Those are all risk factors, and not all of them, but those are a few just off the top of my head. And you gotta at least consider those things, because the buyer will. The buyer's going to go down that checklist and go, he's going to ask all those questions about it. And to the degree that you can answer those, or have answers for those, or have a plan for those, an actionable plan for those, more value, less risk for the buyer means more value for the seller. Period. You know.
Exactly. One thing I would, also add to this, I mean, stepping back into my roots, which are, studying mathematics in school. The question though is always like, how is it that you actually assign a number to this?
Mm-hmm.
And that's a funny thing. You present the same company with the same customer concentration to two different investors. They will see it just differently, even if they themselves have the same set of tools they're operating with. It's extremely subjective discussion. There's no chat GPT or AI engine that today or for the future coming that would be able to, assign a number to this, for which then you're going to, discount back whatever today's current present value is of this business and
That's
its
right.
profits. But one thing that kind of triggers out of this, that was an interesting discussion this past summer. I mentioned I had a few students. I do have a few students that helping me along the way, and I had the pleasure of having them with me here in New York. They all lived or had connections that brought them here. We had a discussion precisely on this risk and how to put a number to it. And I actually, found myself remembering one thing. Risk and negotiation, all of these things are also related to your next best alternative. And from an investor standpoint, everyone's an investor. Owners themselves, they've invested in their business. They may as well have other investments, their home potentially, and other ventures. The question is, if I put X number of dollars on this business, what else could I have gotten in terms of returns from other assets?
Right.
Okay, a year ago, year and a half ago, interest rates weren't really generating much. Now they're in a much different spot without any risk,
Right.
theoretically speaking. And so right then off the bat, you've got that. You look to the S&P 500 or any sort of publicly traded company, large cap, mid cap. These are without question less risky assets, by theoretical definition. And so there's no chance that a company in the lower middle market can be seen to have the same degree of risk. It's just not practical. So I think that's also a way to manage expectations on this and quantify it, just comparing it with the returns that are being yielded by other investments, real estate, and so on and so forth. And that can quickly bring you to a new reality of what we're dealing with here and what an investor's perspective is on this.
As a valuation expert, we deal with risk all the time when I'm doing valuations for companies. And there are people all across the country that do valuations. And I would venture to say that no two people would get the same valuation for the same entity, as they had. It's very subjective. Just a quick example, and I was actually did a presentation on it, the Michael Jackson estate. After his demise, of course, the IRS wants a large value because they want a lot of tax money. So they had a value. I forgot the exact number, so somebody's going to look this up and tell me I had the numbers wrong. I already know the numbers are wrong, but the direction is accurate. And so the IRS valued it like $800 million or something like that. The Michael Jackson estate wanted to value it lower, to lower those taxes. They come up with a number of like $200 million. So here you have two different entities with virtually unlimited resources to hire anybody on the planet they want to value something, and there's $600 million apart on their valuation. And the judge picked neither one of those numbers and came up with his own third number. So it's very subjective. Yeah. Now his number he didn't just average them. He did side closer to the Michael Jackson estate, but not exactly that. But anyway, it's just to show you there's a lot of subjectivity to it. Even for the people that do this for a living all day, every day. I do it. It's one of the things I do. But anyway, Jeffrey, we thank you. I try to keep these things to about 30 minutes so people can listen to them while they're having a cup of coffee or at lunch or driving to or from work. So we're about at that benchmark. But thank you so much for coming. I appreciate you taking the time. We'll provide people with your contact information. So if they got the right business for you, then you can acquire them and then run it and do what you want with it. Thanks you so much, Jeffrey. I appreciate it.
Thank you, Gary. It was a pleasure.
Thank you.